The biggest risks in digital markets aren't always the ones you can see. While most attention goes to price volatility or market trends, a deeper structural risk is quietly growing: infrastructure dependency. In today's digital asset ecosystem, risk is no longer just about the asset itself. It's about the systems supporting it. Custodians, validators, middleware providers, and cross-chain services now form a shared infrastructure layer that multiple assets depend on. And as markets mature, this interconnected structure is creating new forms of systemic exposure. Digital networks are no longer isolated. A small number of providers now support a large portion of on-chain activity. Custody platforms hold massive amounts of assets. Validator operators often secure multiple networks. Middleware services, like RPC providers and oracles, act as gateways for transactions and data. This concentration introduces a critical question: what happens if one of these key components fails? Custodians, for example, are essential for institutional participation, but they also centralize risk. A disruption at a major custodian can impact multiple funds and strategies at once. The same applies to validators. In many networks, a small group controls a significant share of validation power, which can affect security, governance, and transaction reliability. Then there's middleware, the hidden layer most users never see. These services enable access to blockchain data and transactions. When they fail, entire applications can slow down or stop working, even if the blockchain itself is still running. What makes this risk more complex is how interconnected everything has become. A single provider may support multiple chains and platforms, so when something breaks, the impact can cascade across ecosystems, affecting liquidity, pricing, and execution all at once. The challenge is that these risks don't show up in traditional metrics like price or volume. That's why institutional investors are shifting towards systemic exposure mapping, analyzing custody concentration, validator distribution, middleware reliance, and cross-chain dependencies. Decentralized finance adds another layer. DeFi protocols rely on multiple external services, bridges, oracles, and liquidity pools, each introducing its own risk. More connections mean more efficiency, but also more potential points of failure. At Kenson Investments, infrastructure dependency is treated as a core risk factor. The focus is on identifying where concentration exists, how systems interact, and how those dependencies could impact capital under stress. Because in digital markets, risk isn't isolated, it's networked. If you want to better understand the hidden risks shaping digital asset markets and build a strategy grounded in real infrastructure awareness, visit kensoninvestments.com and connect with the team today.